Okay, now let's try to understand how we determine the transaction price. So for determining the transaction price, we need to see one example wherein a customer has purchased a furniture from furnishing company Apex, and the customer will be paying $6,000 within 4 years, and the amount is interest free entirely. So the customer has taken the delivery on the same day, meaning today he has taken the delivery, but this $6,000 is payable to the Apex company after 4 years. So based on the customer's profile, the interest rate is 7% per year. Now we need to determine the transaction price and other interest and other components as well. So for that, it's very basic and simple that if the company Apex company is getting $6,000 after 4 years, then today its value won't be $6,000, because if you are receiving certain money today versus after 4 years, definitely today its value will be lower, right? So how to understand and how to determine that? Let's see that. So what you will say, that the contractual cash between the parties is $6,000, which is due after 4 years, and what will be the present value of this money? So basically, to calculate the present value of any particular year, so you can say it is after 4 years, right? So you will be saying that 1 divided by 1 plus 7% to the power 4, because this simply calculate what is the value of 1 rupee after 4 years at the rate of 7% interest. So when you calculate this number, you will be getting 0.7628. so this is the present value factor. Similarly, if the question would have asked you for 3 years, then you would have said 1 divided by 1 plus 7% to the power 3. So this would depend on a different circumstances. There is a separate session to explain this in more detail, but yeah, this is the present value factor amount. Now how the transaction price will arrive? Simply you will say that this 6,000 is the 4th year's value and the present value factor is 0.76. So when you multiply both of them together, then you will be getting total transaction price as on 1st January. Now effectively what is happening, that there is a hidden financing component between both of these amount, which is $6,000 minus $4,577, because if you are getting this money today versus you are getting $6,000 after 4 years, so the differential is definitely the interest component, what we can call it, right? So we will say the differential of both of them will be the $1,422 as an interest component. Now to understand that effectively more, let's see this thing through a different lens of eyes. So what you can say, that today let me just give you food for thought, that you go to bank today and inside the bank you are getting interest rate of 7% and you are investing a certain sum of money today, which is 4,577, which is this amount whose value is 6,000 after 4 years. So what you will say, today you invested 4,577, you got an interest of 7%, then the interest is 320, and if you add both of them, effectively after 1 year you are having 4,897 in your bank account. In the second year beginning, you are having the same amount in your bank account. Again you will be getting 7% interest, which will turn into $342, and your closing balance will become 5,240, adding these balances. Then this 5,240 again sitting within your bank at the beginning of third year, and you will be getting 7% interest rate again here. So if you add these up, at the end of third year your bank will be having 5,607 in your bank. Then at the beginning of fourth year you are having this $5,607 and you are getting again 7% of interest, so 392 will be the interest. And finally if you add both of them, you will be saying after 4 year effectively my bank will be having $6,000 with it, right? So if someone asks you what is the value of this 6,000 which you invested inside your bank today at the start of the year, so you will be saying it's 4577. And if someone asks you what is the differential number between both of them, so you will be saying the differential number is only my interest component. If you add all those four interest component, that will add up to this 1422. So effectively what's happening, the bank is uh, charging or giving you the interest here, and this is compounding at a effective rate. Okay, the same thing can be seen through our visualization chart I have just made. So at the opening year it was 5477, then in the first year you got some interest, and after adding both of them, this will become your first year's closing balance, or you can call it second year's opening balance here. Then there will be interest on it, and this interest and this amount will make up your second year's closing balance, and then the interest will be there on as well, and the total balance will become 5607, and finally the interest will also be there and it will become 6000. So what is happening, that the $6000 which you are going to receive at the end of fourth year, someone asks you what is that's present value today, you will be saying it's 4577. And to calculate that, what simply you did, you simply did 6000 divided by 1 plus 7% to the power 4, because you wanted to calculate the value of that number today. Now after that, if I talk about the accounting transactions or accounting treatment for that, what you can say that on 1st January you have recognized the debtors. Now instead of looking at this theoretical accounting entries, let's see the visualization first and then let's go to the accounting. Okay, so what will happen on the first day when you have created your debtors, right? So when the debtors will be created, simply what you will be saying, you will be saying I will have my accounting entry like this, that I am having debtors of how much, debtors of $6000, and but out of that how much is your revenue? So simply the revenue is not your interest component as of now, because this interest you will be earning at different years, different point of time. So the revenue for you will be its present value, which is 4577 here. Let me just go here. So 4577, and there will be some discount on financing, or I can say discount on receivables. So if you write that discount on financing, what was the number for that? The number for that was 1422. So I take it as 1422 or 23. Now what will happen, that this discount is not your income as of now. This discount will become your interest every single year when the interest will be recognized, right? So if I have made one account here like discount on financing, so right now within this discount on financing, the amount is sitting like 1423, okay, which is here. Now in the first year what will happen, you will say 1 year has been completed. After 1 year you will simply say that, okay, now I have earned an interest of 320. If you have invested this money into the bank, this money you have invested into the bank, now at the end of 1 year you have 320 as an interest. So what will happen, you will say, if I am making my interest account, you will say my interest income has increased or became 320. But from where this interest income came? This interest income came out of this discount on financing. So basically this 1423 was there. So out of that 320 is now reduced, because this has become your income. You have recognized it, right? So effectively your interest will be here, and for that what accounting entry you will pass? You will pass your accounting entry like discount on financing. Why? About how much? 320, because you need to reduce this credit amount to debit amount, and now you need to recognize your income. of interest here, which will be again 320. So what is happening? This 1423, out of that 320 is reducing and your interest income 320 is increasing, which is in this chart. Okay, in the second year as well, what will happen? You will say second year will be exactly like that. In second year my interest income will be 343, which was here again. Okay, 343, but this interest income 343 is here, so it will be reduced from where? You will be saying it will be reduced from discount from financing, and it will be increased where? You will be saying it will be increased in my interest income account. So this is increasing here in the year 2. Similarly, in the year 3 it will happen. 367 will be reduced from your discount on financing, and 367 will be increased on your interest income. In the fourth year it will happen same. Now after fourth year, meaning at the end of fourth year, what you will say? The interest income in totality has become 423, which is your closing balance, right, which was since our beginning. And effectively your discount on financing, that account which you created, that is getting reduced, and after fourth year it will become 0, because it has now shifted the discount on financing from liability account to your interest account. And after sixth year, what will happen? You will be receiving cash from your debtors. So the entry will be cash account debit to debtors or accounts receivables, and they will be paying you $6,000. So $6,000 will be here, and that cash account will be like this. After sixth year you will be receiving cash from debtors, and its closing balance will be 6,000, because cash is, it's in the form of closing balance sitting there. Now the same thing I have created in accounting entries for you as well. So let's have a quick view and then conclude this conversation. That at the inception, when the debtors are created, so you will be saying accounts receivable 6,000, your revenue is your present value, and remaining is your financing liability. Out of that financing liability, every year this is credit right now, this will got debit because we need to reduce it, and interest income because we need to increase it. In the second year the same entry, in the third year the same entry, in the fourth year the same entry, and in the fifth year you will be receiving cash of 6,000, and your accounts receivable was here debit, and you need to close this account, so you will be crediting your accounts receivable by $6,000. So in this way we have determined the transaction value alongside the present value concept.